Honestly, everybody, cheer up. That's the message from most big investors at the moment. The collapse in the oil price that should be seen as a much-needed big fat pay rise for much of the world is doggedly viewed as a solid negative, and it's drawing in everything around it. The correlation between oil and stocks and oil and credit is running at well over 90% on an intraday basis. That's the sort of correlation that gets algo writers paying attention, so it very quickly becomes self-fulfilling. No matter that plenty of assets should gain a boost from weaker oil prices. If it moves, sell it. One illustration, though you could pick many, is that only 3% of investment-grade corporate credits in Europe have made gains so far this year, when 20% are credits that are in retail and consumer sectors that, quote-unquote, should benefit from cheaper oil. Of course, there are sensible reasons to worry that the drop in oil is more sinister, but some investors reckon, or hope, that it's only a matter of time before markets start accentuating the positive. After all, central banks are rushing to the rescue. Citi did a straw poll of its clients recently and found that 57%, a decent majority, think January's washout in the markets was a blip. Buy the dip, they say. As will.i.am famously and somewhat ridiculously said at Davos, it's time to put our optimism goggles on. The problem is that for investors looking after other people's money, there's a fine line between buying bargains on the dip and catching a falling knife.